Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The chart you see here is dollar versus euro, which is the EUI is the root symbol of this listed on the ISE. If you go to your standard brokerage system and you put in the symbol EUI as you would whether you're trading at E-Trade or Options Express or Thinkorswim, whatever, you put that in, however you would be. Sometimes it needs an asterisk or something in front of it, and click it in there, then click the options chain. All the options will roll out for the for the US dollar, euro traded currency options on the ISE, and you'll see these going all the way out to March of 2010. I went in this morning before anything happened, and I pulled out a December 81 call just to give you an example of this, again on the ISE, EUI, and I'm sorry, I meant to write the particular symbol, but I forgot. I forget what it is now, but needless to say, you can find that on there. So if you go look in the option chain, December 81 call, and the reason I chose December 81 call, right now, dollar euro is trading right around 77. So this is a call. We have, another 8 months for this to play out. This call is priced at 276 was the ask, and again, this may not be updated prices, but these were prices from yesterday. 2.76 means it costs you $276 to buy one of these call options. Again, the beauty of this, they trade in sizes that make these call options affordable, so you can get access to this market with a very low relative amount of capital compared to some other markets. So soon we see a move, and this was the assumption I made, that we see a move in the US dollar euro to 90. All right, say it goes to 90, 77 to 90. That's a 16% move from where it is now. Now you see when the credit crunch started, US dollar euro jumped 24%. So I think to say in a very short period of time, so I think to use 16% is fairly conservative estimate, assuming this global macro plays out. Well, if we went to 90 and we look at this same call, and that should be, US dollar EUR at expiration, the option would be what's called, 9 points, about 9 points in the money. I said from your 81 to 90 is 9 points, so you're 9 points in the money. So even at expiration, if you're in the money by 9 points, it's worth $9 each, or $900, and it costs you $276. That represents a profit of 226%, not including commissions, which would be a very small part of this. But say you bought this thing, and all of a sudden we had a major crisis in the Eurozone, and we woke up one day in Italy and Spain said, hey, we're getting out of the system, and Germany said, we don't really like this exchange rate mechanism anymore. People are mooching off of us, so to speak, and the euro goes to parity. Say the euro goes to 1-to-1, which isn't out of the ordinary. Started all the way back here, back in inception, and this is where the dollar bear market started. So say we even go to parity on some concern about the euro crisis, a potential euro crisis. Well, then this thing goes from 9 points in the money, it's another 19 points in the money. That's a massive return, and we're looking up around 700% return on a trade like this, an 8-month trade. You know exactly what your risk is, $276 each. It can't be more than that. You have a vision of the global macro and how it will play out. So this is the way we'd like to use these. Not always going out this far, but we simply will buy a put or buy a call or recommend buying a put and buying a call going long to make a directional bet based on our global macro view. I said earlier, I don't necessarily like to use these for short-term trading because over time I've found that, yeah, you can use them for short-term trading, but they're not priced as efficiently as some of the very, very liquid markets. But I think they're great for the intermediate and long term, and my time frame there is maybe a couple months out to 10 months. We've bought options and trying to let this stuff play out over time. You get it right, you're going to be in good shape with these, and again, you can get plenty of leverage for a very, very low cost, and that's the beauty of using these options and trading them this way. You put the trade on, you don't have to watch your screen every day, you don't have to wake up at 3 in the morning as I do and watch the spot market. Summary of what's all about. Again, the ice age, unwinding of debt, and rising savings could potentially crush the export models. It could trigger some disruption in China. It could hammer commodities lower again, and I use the word could because, the market will tell us whether or not all this plays out. If it does, the emerging market currencies, we're going to see another major capitulation out of the emerging stock markets, which again exposes the euro in a very, very big way, exposes the pound because of the Eurozone banking system blending to the emerging market area. Also, which I didn't talk about, we really do think that, say things go along even as they are, we think the U.S. emerges from this morass first before any of the other countries because of the fact that the U.S. still has the best capital markets, although the government's doing the best they can to mess that up, but we still have the deepest and most efficient capital markets. We still have relative fiscal flexibility, and what I mean by that is the U.S. government still has taxing power, as ugly as that is and as much as I hate it. The U.S. has the ability to tax more to raise more revenues. Japan and Europe, if they continue pressuring their consumers with more and more taxes, they're going to see major revolts, and we're seeing some real upset in Europe anyway. The U.S. still has better labor flexibility, much better labor flexibility and productivity than the Eurozone and most countries that it competes with. A lot of that's being hampered by the housing market. People are being trapped in their homes a bit, but again, so we think that the U.S. can emerge from this morass first and still potentially be beneficial to the dollar. The major risk is if the U.S. pumps too much debt in the system and tries to recreate the system before of a debt-driven, asset class-driven economy, which leads to an implicit weak dollar policy, then this story that I just told today is history, and the U.S. dollar goes back into a multi-year bear market. That can happen, and we're open to it. We think, but we don't know, that President Obama's economic advisor, with Paul Volcker on board, is a little smarter than that. But given what we've seen so far, we're still not sure. So there are key risks to suggest that what I've said here could be all wet, and again, we're very, very open to that. Additional information, Steve said, fxoptions.com to provide specific information on the currencies, currency options that they offer. A lot of great information there, some great articles by Steve. Black Swan, here's how you can contact us. And we offer a currency currents, as Steve said, which is our free newsletter you can sign up for, and our currency strategist, which is our subscription-based letter that we give recommendations for the ISE FX options in there and other classes.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.